Good afternoon. It's Jeff Christian from CPM Group in New York. This is CPM Group's open forum on silver. We have done open forums in the past live, and then we've had long, 1 hour, 2 hour discussion groups and question and answers on Zoom and GoToWebinar in the past. There's a lot of discussion about silver in the public right now, so we have decided to have this event. We have two interlocutors, questioners, moderators, Cory Fleck from the Korelin Economic Report, an impartial, biased journalist with a tremendous amount of knowledge and experience in the financial markets, including and especially perhaps precious metals, and Happy Hawaiian, who has become in the last 3 or 4 months a internet silver personality, and he will be asking a lot of the questions. We have questions that Happy has been collecting from people on the internet. We also have questions that have come into CPM Group that we've passed on to Cory and to Happy. I have not seen Happy's questions. I saw some of the questions that came into CPM simply because they were coming into info@cpmgroup.com, and I see that. But I haven't seen the questions. I haven't really gone over them and studied them or anything. It's pretty much going to be an extemp type of thing. For those of you who don't know CPM Group, we've been doing commodities research since May of 1986 when we spun out of Goldman Sachs. Prior to that, we were the research department at J. Aron, which then merged into Goldman Sachs in 1981. And then we did a leverage buyout of our group in 1986 and set up as an independent research consulting company. Those of you who do know us know that, prior to the 1990s, mid-1990s, CPM Group and Handy and Harman were the two companies that produced estimates of silver supply and demand. And we've been doing that all along. We just came out with our yearbook a few months ago. I guess earlier this month, actually. And we're pretty much known for knowing about precious metals. We're doing this because, as I said, there's a lot of discussion about silver in the markets, and we wanted to give people the opportunity to ask us the questions they want to answer. Before we jump in, and I'm not here to lecture, if you look at the demographics of investment demand, and various mints and other groups have done studies. Who's buying silver eagles? Who's buying silver maple leaves? Who's buying gold coins? And what you find is that 90% of the people who are buying precious metals investments are college educated, professional, upper class, 40 to 65-year-old people. And they're buying these metals as part of a portfolio diversification and wealth diversification strategy that they have. The other 10% tend to be more event driven, and a lot of the 90% people of the buyers who buy precious metals are actually more driven by economic, political, and financial market developments than they are in gold and silver developments. What we find is there are a lot of investors and other people who look at the world and they see imbalances and they see strange developments. They see a tremendous amount of money coming in from monetary authorities and fiscal stimulus, and it doesn't seem to be trickling into the real economy, but the stock market's doing very well. They wonder why the Treasury spent $1 trillion bailing out the banks in 2008 instead of $200 billion bailing out homeowners. They see a lot of things that they don't quite understand, and they seek answers. And when they seek answers, a lot of people turn to the internet. And there they find people who are marketing precious metals. They're marketing viewpoints. There's a lot of conspiracy theorists. There are a lot of people who hold themselves out as experts who are not necessarily experts in these markets. And they sometimes fall prey to that. We will never change the views of those people who are marketing precious metals based on fear and misinformation, because that's their job, that's their cottage industry, and that's what they're going to do. They feed on to true believers who really have deeply founded beliefs, and will never change their views, because to change your view if you're a believer based on evidence and facts and observable reality is heresy. But we can reach out to those 90% of those people who are not true believers and are not snake oil salesmen, who say, I really would like to understand why I'm seeing things like this. And the only people who answer it are oftentimes not quite realistic. So that's the audience that we're trying to reach out to. There's a thing called the Ignatian imperative. St. Ignatius came up with it. He said, if you want to have a discussion with somebody who has diametrically opposed views to you, the first thing you must do is fully understand their views and the origins of their views. Because when you understand the origins of their views, then you can understand why they hold those views. And I have lived my life with that, and I hope that other people do too. Obviously, watching the evening news, I see a lot of people don't, but that's why we're here. On that, I'm going to pass the baton over to Cory Fleck to give his introduction and some preliminary comments. And I have a small cup of espresso here, so let's start.
Thank you, Jeff, and thank you everybody for tuning in. Again, my name is Cory Fleck. I'm the host over at the Korelin Economics Report, KE Report. I cover a lot of the markets every day, and we focus a lot on resources. I've had Jeff on my show a number of times. We've talked through at least some of these issues we're going to get to today, but this is much more an open forum where we are going to be taking all of your questions. As Jeff said, I have been emailed questions, Happy has been emailed questions, and so is the CPM Group. The questions that I've been emailed and that Happy is emailed, we've talked about them, but we haven't already brought them up with Jeff. And you will also have the option to ask questions in this webinar format. There's already been a couple that have come in here, a couple that make me chuckle. We won't be able to get to all of them, but there will also be a recording available. So that should answer a couple of those already questions. I'm going to be a bit more of a moderator here between Happy and Jeff. I want to make sure that we stick on topic. I want to make sure that we're getting to as many questions as possible. And I want to make sure that we're progressing through this. And quite frankly, Happy has done a great job of building this audience of what are sometimes newer investors in this space. So we're trying to make this sector all make sense. Happy, start us off, please. Give us the initial topic here. What are we going to start discussing? What road do we want to start with? Where have you seen the most questions come in?
Yeah, so I'm the Happy Hawaiian. I am, as Jeff described, an internet personality from Reddit and Twitter. And in terms of topics, we really are all over the board. I was planning on starting more broadly with the gold and silver markets and Jeff's views on them. And then, by the end of the open forum, getting to some of the specific quotes that people were asking about, specific things about manipulation, and just really roll through this. But I think it's good to get a good grounding in the overall market, and to Jeff's point, he wants us to be educational, so we'll start there. With that, I think one question I got in many different forms, and this is just a good icebreaker here. In terms of a prediction for price in, say, 1, 5, or 10 years, what's the highest, Jeff, that you could see silver getting on, say, an intraday basis, blow off top? Not necessarily it's going to stay there, but just the absolute, if you had to guess, you win a huge prize if you got the closest. What would be your blow off top highest price point prediction for, say, the 2020s and perhaps 1 year, 5 year as well?
Okay. In terms of for 1 year, that's the easy one. We're looking at the potential for $32, $33 again. We saw a spike up to that in the first quarter, I believe, and we wouldn't be surprised to see a spike up again. That said, our expectation for the next 5 months is that the prices move sideways and test some downside. We see support at 23. It's possible that it could go lower. We see resistance that we're testing today at $28. I think we're on record as saying that the price can spike up to $30. Over the next 5 to 10 years, that's an interesting division, because our expectation is that at some point in the next 10 years, there's going to be another financial crisis and another recession. And there's going to be a series of issues in the financial markets that are going to cause people to want to buy a lot of gold and silver. And when that happens, our published projection is that silver rises to record prices. Now, it's impossible to econometrically say, okay, this is when the next recession is going to occur, and this is the depth and breadth that we're going to see. Econometrics just don't work that way. Some people try it and it fails. We've put a wet finger in the air and we've said, our best guess is 2023 to 2025, we see another recession and another financial crisis. There are all these problems that have been building up in the world really for 40 years, and then they've been more intense for 20 years, and then they've been more intense for 12 years, and they just get papered over, and they do need to have some, if not resolutions, some work done on them. And they all pose risks to economic activity and financial market stability and political stability. And our expectation is that over the next 5 years to 2025, those come into play. Now, when we project our 10-year projections for silver prices, we project real and nominal prices, and we project annual prices. Our expectation is that the annual average price in that 2023-2025 range will reach a record level, something probably over $50. Now, that's an annual average. You want intraday. Well, let's look at past spikes. In 1980, the price got to $50 on an intraday basis. The annual average was $16, I believe, or $20. In 2011, the price got to $50 on an intraday basis, and the annual average was something like $30 or $32. So if we're saying that we think the price could average $50 or $52 or $54 in the next spike, obviously the intraday peak is much higher. We don't think it goes to $100. I think there's some magical beliefs, in $100. We've seen people projecting $100 since 1981. By 1981, they were saying, oh, 1985, we'll see $100 because we're running out of silver. 1987, oh, we'll see $100 any moment now. And we've seen that over and over again. And I don't know that you'll see that. I wouldn't be surprised to see $75 on an intraday basis. But the thing is, silver is a commodity. Not only is it a financial asset, it's a commodity. And there's supply, and there's demand, and there are inventories, and there's secondary recovery. And while the price can spike high, it can't stay that high, because there is a lot of silver that can come into the market at $50, well, even at $30, and then $50 and $60 and $70. So you can see a price spike, but I doubt that you can see it stay that high.
Now, Jeff,
Okay.
One other point to talk about here, that supply side that you're getting into. What about the demand side? In terms of, I think what Happy's asking too, intraday high, it's a different world out there with the Reddit forums, with this online community. Is that a key component that you're starting to build into your models?
No, we're not actually building it into our
Why
model.
not? Is that not something?
It's there, but as we look at the dynamics of the silver market, investment demand in PSLV, SLV, investment demand in coins, movements of bullion into the London market, into the New York market. The Reddit thing doesn't seem like a major issue that's going to have a major impact on the price of silver. And related to that whole issue of the price spike and on an intraday basis is the question, which, let me anticipate it, can we see a squeeze? And the answer is yes, you can see a squeeze, and it will last for a day or two or a week. But because of the arbitrage that's available around the world, and because of the availability of metal around the world, you could see a squeeze push the price up, but you can't see a squeeze keeping the price up.
Okay, fair enough. Short-term moves. Happy, what do you think about that answer? Is that what you're getting at there?
Yeah, that's what I was going for. I think what you said there was maybe mid 70s. Is that, if we were just picking a number, is that what you were saying, Jeff?
Yeah, I mean,
Okay.
it's really
And
hard to.
sorry, I have a quick follow up. I think someone was pointing out in one of your recent videos, you said silver might hit a new inflation adjusted high during this
Yes.
run up.
Yes.
And using the CPI figure, somebody calculated that to be $140 based on the $50 high in 1980. So are you now, I guess, lowering your price target for the decade, your high for the decade, or do you, I guess, calculate inflation from a different point, or
Yeah.
what's
I
going
don't
on
know.
there?
Well, I don't know what inflation numbers they were using. We're using right now a 2% inflation for most of the coming decade. We're not concerned about hyperinflation. We're much more concerned about deflation. In that way, we are closely aligned with central banks and mainstream economists who see the current increase in inflation as A, not all that big, and B, transitory, related to coming out of the pandemic, the lockdown, and the recession. So our longer term concern, and we're talking the next 10 years, is much more about deflation rather than hyperinflation.
Right.
That said,
And
hyperinflation expectations factor into gold and silver prices.
okay. And we're definitely going to get into inflation. And this was not about the inflation outlook. It was saying, if you look at the $50 price in 1980 and then adjust that for the inflation that's happened subsequently, it would be approximately $140 on a present day basis. But in the essence of time, I think we should keep going here.
Sure.
Just starting off,
looking at our real and nominal prices,
okay.
I don't think that if I'm looking at our real and nominal prices and we deflate it backwards, I don't necessarily think that that's necessarily good at arithmetic.
Okay, we'll stick to the 70.
Yeah,
70
we can follow. Yeah, 70s it is. In terms of people, a lot of people were questioning whether CPM Group itself can be an unbiased commentator of these markets. So there's a few questions related to that. Just to start off, does CPM Group benefit in any way from higher or lower metals prices, either directly or by virtue of their clients benefiting from the price being either higher or lower? Or is CPM Group price agnostic in terms of how it could affect the business of CPM Group itself?
Yeah, we are price agnostic, and we work very hard. We always say our clients don't pay us to be bullish or bearish. They pay us to be right and tell them where we think things are going and why. So we try to be agnostic. Now that said, and it's one of the funnier things about the people who criticize us without really knowing us. Obviously, we are pro silver. We're bullish on silver. I haven't spent my life studying precious metals because I'm anti gold and silver. I mean, that would be really sick. So we have that. Now, if you look at CPM Group's revenues, it's an interesting thing. Higher prices definitely help us. They help us for a variety of reasons. One is that there are more people making money in precious metals, and so there are more people who feel they can afford our work. Also, as the price rises, because the prices also fall, you have increased nervousness. So we'll see more people coming to us and saying, tell me, is this too good to be true? Is this too good to last? What should we expect? Strangely enough, in the middle of the market, when prices aren't doing much, that's the worst time for us. When prices fall very sharply, we will sometimes see an increase in demand for our research because you have those guys who say, gee, I thought silver was going to $100 and it isn't. And now my mind is losing money. You guys got to help me here. Really low prices will sometimes help us, but higher prices help us much more than lower prices.
Jeff, just explain to us a little bit more how you advise clients. Is it on the buying? Are you on the buy side? Are you on the sell side? How do you advise clients then?
We never take the opposite side of a client transaction. We would never buy or sell to a client. Clients will hire us to buy and sell for them. But we provide them research, say, this is what we're seeing, this is where we think it's going. These are the signposts that we would watch alongside the highway to say, if this happens, call us because it may have an implication for silver. So we provide research, we provide consulting, then we provide investment strategies. And we're very big on option strategies. So, for example, when the price spiked up to $30 earlier this year, $32 earlier this year, we were saying, don't sell your gold, silver if you are a long-term investor, but buy some puts here with the expectation the price is going to fall back and you can sell those puts back profitably. So we'll help clients with strategies, and then sometimes they throw up their hands and they say, that's more sophisticated than I'm comfortable doing. Will you handle my money for me? But we never take the other side of a transaction.
Okay. Thank you.
And as a follow-on to this topic, the question is, does CPM Group have central banks as clients, as they have boasted about in previous presentations? Does this potentially create any conflict of interest when commentating on the precious metal markets?
Okay, well, first off, we've worked with virtually all of the major central banks in the world, around the world, over the last 35 years that we've been in business. Honestly, our work was much more important to them in the late 1980s and 1990s. Central banks have really pulled back significantly from the gold market since the aughties for a variety of reasons that I won't go into unless you really want me to. But central banks are much less important, or much more less focused on gold than most people think, and than they used to be. So we still have central banks as our clients, but the business that we're doing with them is much more maintenance, research, and consulting than it used to be when they were more active in the gold market. So that's the reality of our book, without disclosing names. That said, it doesn't form a conflict of interest with us, except that with central banks and with every other client, we learn a lot about their business, and it's all confidential. And we always have to be careful that while we can take into account what we know in our projections, we must never base our projections on confidential information. Oh, we know this guy's going to do something, so therefore, So there are things like, as a historic example, in 1992, we saw indications that we had been bearish for gold and silver silver we had been bearish since 1987, 1988. Gold we turned bearish in 1988. And we said, these are the things that we're looking for to turn bullish. And in 1992, we said, those things are turning bullish, but we happen to know that there are some central banks that have sold forward for delivery in the first quarter of 1993. And that was kind of a break in the confidentiality. And we said, so those forward sales and the forward deliveries will keep the prices down into early 1993. But if everything else hangs together, you have to remember 1992 was an election year when Bill Clinton won. But we also had the Gulf War. We had the bombing of the Trade Center in February of 93. We said, if all of those other things that we're looking at hang together, we think the gold, silver, platinum, and palladium prices will all start rising, starting in the first quarter of 1993. So we have to be careful that we don't give up too much information in taking into account what we know in the market.
Okay. And this is a quick follow-on from that. You may have partially answered it just now, but do central banks intervene surreptitiously in the gold market? And if so, for what purposes? And likewise for the BIS, in terms of the gold or silver market, do they intervene? I think you just expressed an anecdote where they were active in the market, and you described that perhaps that trade in 1993 may have suppressed prices for a time. So I guess to what extent are they participating in the market, and what effect does that have, and why are they doing that?
Yeah, okay. First off, in 1993, that was a couple central banks that were selling gold because they had like 95% of their foreign exchange reserves in gold, and they needed dollars so that they could defend their currencies. And this was in the aftermath of the euro crisis in September of 1992, when the snake, the EMS that predated the ECU had basically broken. So there were issues there. So that's 1993. It's a long time ago. But that bank wasn't trying to intervene in the gold market. It was trying to sell gold. And you would see that in the past. I mean, there are a variety of reasons why most central banks that wanted to sell some gold sold that gold prior to 1999. And then there were a couple banks that stood back and they sold between 1999 and 2005. Most central banks that wanted to sell gold have sold the gold they wanted to sell. And so central bank sales are very small these days, really since 2005. Meanwhile, other central banks that hadn't really been heavy traders in the gold Bretton Woods system and didn't accumulate a lot of gold in the 50s and 60s have started buying gold because most of their assets, most of their monetary reserves are in dollars and euros. So they're diversifying their portfolio and they're buying other currencies and they're buying gold. So you don't necessarily see that. To your question was, do we see central banks today intervening in the gold market? And the answer is no. The BIS gets involved because it provides liquidity to central banks and to some extent to the commercial banks that are supervised by those central banks. And so you will see, it's a strange thing. The BIS will have, the monetary authorities will have regulations for commercial banks in terms of the liquidity ratios they have to have and the reserve ratios they have to have. And gold is disadvantaged in some of those ways. So what you'll find is that banks will do dollar gold swaps so that they can have dollars and account for them at 100% of value. And so they'll swap gold to the BIS in exchange for dollars. So you have about 18 million ounces of gold at the BIS right now, which is up from where it was prior to 2007. And a lot of that is gold dollar swaps. It's not because they're trying to do anything in the gold market. What they're trying to do is provide liquidity to other central banks and to the commercial bank that those central banks regulate.
Okay.
Jeff,
and
let me just
switching,
jump in here, Happy, one quick sec. Doesn't this provide too much power by some institutions if it's not central banks? If some institutions out there are holding such large positions, even if they are just swaps creating liquidity?
Well, I'm not sure what you mean. I mean, one of the things that's happening, for example, I said, central banks don't really sell a lot. They also don't lease as much gold anymore because they've basically been squeezed out of the leasing market by a variety of factors, including the fact that a lot of private institutional investors and high net worth individuals realize that they could lease their gold out. And they have far less stringent regulations on the leasing arrangements and the swap arrangements than do central banks. So insofar, so that's one of the factors. Another thing is that the demand for leased gold from jewelers and miners and others is way down from what it was in the late 80s, early 90s. So there's less demand for leased gold, and there's this competition from regulation light. You can borrow gold from a private investor a lot more easily with a lot smaller lease agreement than you can from a central bank. Central banks tend to be much more thorough in their documentation as to terms and conditions under which they'll lease you metal. So the central banks have kind of gotten out of that. And you've seen an increase. I mean, we put a chart in our gold report probably 15 years ago where the amount of gold held by private individuals and institutions is greater than the amount of gold held by central banks. So about 1.3 billion ounces, 1.4 billion ounces held by investors, institutional and individual, and about 1.1 billion held by central banks. So there has been a power shift over the last 30 years away from central banks having more gold to private investors, some of whom are very large institutions, having more gold. So there has been a power shift, yes.
Okay, Happy, back over to you.
Right, and I think we're going to get right back to this topic in a second, but I wanted to ask this question early since it's relatively basic. Someone asked, fundamentally, why should people hold gold and silver in their portfolios? Relatedly, you had a video titled "Gold and Silver Need to Be in Your Diversified Portfolio" that you posted about 2 weeks ago. And what percentage allocation would you consider a good recommendation for the average investor? How much to gold and how much to silver? So to sum up, what allocation percentage-wise would you recommend? And I guess if you had to describe, and you only had a minute to tell somebody why they should have gold and silver in their portfolio, what's your big 2 or 3 points you would say quickly if their life depended on it?
In 60 seconds, you should have gold and silver in your portfolio because you should diversify your wealth away from your domestic currency, and you should diversify your investment portfolio away from your domestic currency, stocks, and bonds. If you have gold and silver in your portfolio, to some extent, it helps reduce the volatility of your wealth over time, and it also opens you up to capital appreciation. Our work has shown that since 1968, an optimal amount of gold in a diversified portfolio was actually about 25–30%. Most people don't want to have that much gold in their portfolio, and it really depends on the individual, how much wealth they have, et cetera, et cetera. In China, a lot of people don't look at it as a percentage of their wealth. They look at it as a percentage of their living expenses, because they have a long history of social instability prior to the communist takeover, and even after the communist takeover, truth be told, although that'll probably get me in trouble over there. And so they think in terms of, well, if I need to live off of my gold and silver, how much should I have in order to live? It varies from person to person how wealthy you are. Gold is obviously much more stable. It's much more recognized on a global basis as quasi-money. But silver has its advantages too, including the fact that it tends to appreciate more sharply. I think it's probably more than 60 seconds.
Yeah, I think the person died whose life depended on it. So in terms of say a minimum allocation you would recommend, or maximum, or just average, do you have any kind of number? Obviously, it's not financial advice. People should consult their own advisor and all of that, but people are dying for a percentage here.
It really depends on how wealthy you are and your circle.
Let's say they have $1 million in their retirement fund. They're 40 years old. 2% in silver, 8% in gold.
If you're a North American investor and you have $1 million in your retirement assets, you probably should have 100,000 to 150,000 of that in precious metals, and that should be diversified among gold, silver, and maybe some mining stocks.
Okay.
So 10 to 15%.
Yeah.
Let's go 10 to 15%. Would you say 2 or 3% is fine for silver then, since it's supposed to be kind of silver? Okay.
Yeah.
We were just talking about central banks and them intervening potentially in the gold and silver markets, their activities. In that same video about why you should have gold and silver, you described gold and silver as currencies. You said, we always say that gold and silver are not the same as commodities. They are primarily financial assets. Gold and silver, if you look at the way they are traded around the world, they trade like currencies and interest-bearing securities. They trade like T-bonds. They trade like dollars. So we have a few questions related to this. Is the fact that gold and silver act as currencies in the marketplace the reason why they can support a fractional reserve banking system built upon them? And I guess, we can ask that question, and also, more basic, could you possibly confirm that, precious metals have a fractional reserve banking system built around them to begin with?
Well, you don't have to be a currency to be fractional reserved. You will find people who will lend copper and aluminum and other commodities too, and they'll charge a lease rate. It's the same way that they charge a lease rate for a couch or a television or a car. So the idea of leasing assets out is not limited to currencies and not limited to precious metals. I always say, if you're thinking in terms of a fractional reserve currency, you probably are thinking about markets in an inefficient way. But yeah, precious metals have a fractional reserve currency. And from what I can tell, they probably already have, always have. I mean, I know going back to 1450 and the British invasion of France, the British government borrowed gold primarily from various other people, entities, and individuals to finance the war. So yeah, it's always been that way as far as I can tell.
Okay.
Okay. So this is something that's built into the precious metals market. It's built into all markets, is what you're trying to say.
Yeah.
Okay.
Yeah, and I think in our conversation, you compared it to the normal banking system and said it was a lot less risky in terms of the overall leverage ratio present in the precious metals fractional reserve system relative to the one based on dollars. And in terms of that, what is the overall leverage ratio would you estimate that bullion banks are operating with today? I think I remember you mentioning a number around 8 to 12, and that's much lower than the dollar banking system. But could you just elaborate on that, perhaps?
No, it's not actually lower than the dollar banking system, but I don't recall saying that it was less risky than dollar lending, because frankly, I think the dollar is less risky than gold and silver. And it depends on what part of the banking system that you look at. So if you're just looking at the United States, if you're a commercial bank, nationally chartered commercial bank, you fall under the guidelines of the OCC, Office of Controller of the Currency. And the Office of Controller of the Currency and the Fed and the Treasury say you have a 10% reserve requirement for your US dollar deposits. So if you have $1 billion of deposits in US dollars, you have to have 100 million of them in the bank. And then there are other guidelines too. For example, you have to nowadays, you have to calculate what the high water mark that you reasonably think could be the draw for your dollars over a 30-day period. And you have to have sufficient reserves to meet a maximum 30-day draw. And that's to avoid the kinds of bank rushes that you had prior to the creation of the Fed, because that caused depression after depression in the 1870s, 1880s, 1890s, runs on banks. So there are different guidelines, but it's a 10% reserve requirement right now for the US dollar. The OCC says if you're a nationally chartered bank and you have gold and silver deposits, you have to have a reserve policy that is prudent. And you define and decide what a prudent gold reserve requirement is. My experience with banks is that they are more cautious with gold. So if the reserve requirement for dollars is 10, they tend more toward 8 as a reserve, or rather 12 as a reserve requirement, so that they will be less likely to lend out gold than dollars. So I think they tend to be more cautious. But that's only for commercial banks. There are a lot of non-bank financial institutions, including insurance companies and investment banks and brokerage houses and others that lend metal out, and they do not fall under the purview of the OCC. So they can do what they want to. And some of them have been more cavalier than others. And some of them went bankrupt in 2008 and were put under the guidance of commercial banks in order to try to clean up their balance sheets. And that's just the US. Then you go overseas to Europe or to England, which is now no longer part of Europe, and you can have different reserve requirements. And then you go to places like Turkey and India, and I think there's a third country, and they have more interesting uses of gold in their monetary system and in their reserves. So they allow Turkey and India, the Reserve Bank of India and the Turkish Central Bank, allow commercial banks to meet some of their reserve requirements with gold, which frees up Turkish lira and Indian rupee to be lent into the market to provide liquidity that's needed to avoid recessions and other economic calamities.
Okay, guys, let's keep moving through this here because we have a lot of other questions that are getting into other aspects here.
And we're mostly talking about gold.
Yeah.
Right. One more on this. Does the structure that you just described make it possible for more of a classical bank run type of scenario to occur in the bullion banking system, given that they are calculating a reserve ratio, and if demand for gold or silver in the short term surpass their estimates, they may have to bring down the overall leverage in the system.
Yes and no.
Potentially causing, okay.
Right. In theory, it makes the concept of a gold rush, or instead of a dollar rush on a bank, more possible. But in reality, because the banks are aware of that, they, as I said, they're much more cautious with their gold, and so they probably are. Well, they're not. They're more cautious. So I think that in theory you could argue, oh yeah, these guys can come in and squeeze this market, but in reality, the banks tend to be much more cautious. And there is a rule in the United States which says that it's illegal to try to destroy a nationally chartered commercial bank.
Okay. And in the essence of demand for questions coming in, I think we kind of need to skip to some of the more recent comments and things about manipulation.
Yeah. Is there a point that we're going
we'll come back to
here,
these.
Happy? Like, is there a certain structure that we're getting to here? Because we've talked a lot about kind of a general high level sense here, but is there anything that you want to dive more into? People do want some like more pertinent, time sensitive information.
Yeah, there's definitely a path, but I think we're gonna switch to skipping around a little bit. In terms of the recent silver squeeze attempts that have been perhaps perpetuated by the online retail community, there's been a lot of comments by other precious metals talking heads, as I would call them. One of them is Jeff Curry of Goldman Sachs Commodities Research. He's the head of commodities research for Goldman Sachs. He's made a number of comments, and people are wanting you to perhaps comment Jeff to Jeff on your opinion of these things. He has the same initials as you, so there's a lot of confusion in terms of who actually said these things a lot of the time online. The first one that caught a lot of people's ears is he said, in terms of how you are going to cause a squeeze, the shorts are the ETFs. They buy the physical and they turn around and short futures in the COMEX to be able to hedge that physical position. Now, this quote has given people a lot of confusion because they don't understand why a long-only ETF may be hedging. They don't actually have any price risk themselves. That's for the investors. And then there is an insinuation that Jeff Curry was perhaps talking about the authorized participants behind the ETF, that they are shorting futures as flows come into the ETF. Do you have any opinion on what he meant by that statement?
Yeah. Look, I'm not a spokesman for Jeff, and I'm not a spokesman for Goldman Sachs. And I'm not particularly close to him or friendly with him. But when I heard that, I did reach out to him and I said, you know, what were you meaning? Because that, you know, ETFs do not short futures. And he said, no, I meant the APs. And that's probably where you saw the, what you're referring to with the insinuation is that I told you that, you know, what it is. And the APs, the authorized participants who buy and sell shares of ETFs and pay for them or take delivery of physical metal when they sell them, the APs will use futures to hedge their various positions. And what you'll find sometimes, you know, an institutional investor or a large client will call up an AP and say, I want to buy, yeah, pick a number, 100,000 ounces worth of SLV, and or a million ounces of SLV, or as was the case during the would-be squeeze, you know, 82 million ounces or 100 million ounces, whatever it was. And an AP can't say, well, let me work that order for you. In the physical OTC market, and in the good old days before ETFs were around, you could say, okay, I'll work that order for you, and I'll take time to do it. And when the markets created the ETFs, we said one of the problems that the ETFs will, or ostensibly could create, is that you no longer have market makers making markets. You have a guy sitting at a computer saying, I want to buy 10 million ounces of silver SLV right now. And the market makers have been replaced by the APs. They don't have the discretion to say, let me work on that. They have to buy the ETFs and find the silver as fast as possible. And, you know, with the SLV and most of the other ETFs, it's 24 hours. You know, the SLV says, you know, we can have 1,001 ounces of unallocated metal, but the rest has to be allocated at the close of every business day. So the APs are in a really nasty spot because they have no idea from minute to minute, day to day, how many orders to buy or sell ETF shares they'll get, but they have to respond to them. And so they will sometimes hedge their exposure. Say, okay, you want to buy ETFs? Here's the price. The price right now is, you know, $28.14. And I'm locking that in. Now I have 4 hours, 2 hours, 6 hours to find the silver to close this deal. And the price can change dramatically in 2 hours, 4 hours, 6 hours, whatever it is. So I will agree to you that I'm going to buy these shares from you, and I'll hedge that with a futures or an options contract until I can close that order. That's what he was referring to. And it's unfortunate that he said what he said.
So you're saying it's just in the temporary time they're acquiring the metal for the ETF before its ownership is transferred to the ETF. Is that what you're saying?
I should have let you answer it because that was all.
Yeah, the transaction then happened.
Okay.
Can you
I think some people
explain
are.
what an AP is? Sorry, Happy. We have a couple questions coming in asking what an AP is. Just a quick little background on that, Jeff, real quick.
Associated I guess, authorized participant. So when you have a share, like an SLV or ETF, you have brokerage houses or banks that have gone through all of the paperwork to create trading lines with that SLV or ETF. And they say, you know, we are now authorized to buy shares, paying for it with silver, or redeem shares, say, take my shares back and give me the silver. So those are the authorized participants who can actually trade with the manager of the ETF.
Okay, thank you. Moving on, Happy.
And right, I think some people would be surprised that that's what he meant, given he was making the point to counter the fact that you can't really squeeze it by buying the ETFs. So I think there's definitely potentially some remaining confusion there. But within 24 hours of that comment, he also went on to Bloomberg Odd Lots podcast, and he referenced that Wall Street Bets, which at the time had a little over 5 million people, each member of Wall Street Bets would need to buy 4,200 ounces of silver. He referenced above and below ground stocks of silver when coming up with this number. But that would be over 20 billion ounces of silver that he said would be required for Wall Street bets to purchase to corner the silver market, as he phrased it. Is this a wildly overrepresented number of how much silver retail investors would need to buy to potentially cause a silver squeeze? And if so, what's your estimate of how much silver would be needed to be purchased by retail investors to potentially trigger a silver squeeze, intentional or not?
Okay, well, you really have to define what a squeeze is. But let me back up and address your question, because there's squeezes and then there's squeezes, and I think a lot of people don't understand what that is. And you and I have talked about what caused silver lease rates to shoot to 80% in early February 1998. But that's let's set that aside. I have no idea what his math was. I have no similar math that we've done, because the idea is such an improbable development that it is not germane to the silver market as I've known it for 50 years. So, I have no comment on it, because it's just like, as far as I'm concerned, a waste of human effort to even address that issue. How's that?
That was good. Do you personally have an estimate on how much purchasing of physical silver would need to happen for the price to appreciate appreciably?
Well, you have all kinds of indications. First off, you can look at the silver futures market, and as I've talked to you about, and it's on our website in some of the presentations from 2011, 2012, where we've gone in 2011, we said, what are the outsized 5-minute periods? 5-minute periods on the COMEX where there's an extremely unusual outsized buy or sell volume. And it's important to say volume, because it's not an order. It's in most cases hundreds, in some cases thousands of independent people all reacting to the same price move. And what we found, if I remember correctly, it's like I said, it's on our website in our market views in those presentations from 2011, 2012, when this was an issue among some people. There were like 7 outsized market moves in January to October of 2011. 4 of them were pushing the price higher, and 3 of them were pushing the price down. Now, those are futures, they're not physical silver. And the price increase or decrease tended to last on that day. So it wasn't a permanent increase. And that's why I was saying you have to define squeeze. Are you talking about squeezing the market for an hour? Or are you talking about squeezing the market forever? And those things were like for an hour, right? I also told you the anecdote from 1998 where there was a congestion in the silver market in London because Berkshire Hathaway was taking delivery of its silver. And there was one bank that had agreed to sell 5 million ounces in February of 1998 to Berkshire Hathaway's agent that was doing the purchasing. And they were unaware of what was going on. And they said, we need to come up with 5 million ounces. Let's see if we can borrow it. And they went into a market that was extremely tight because everybody else was scrounging to meet their requirements to deliver into the Berkshire Hathaway February deliveries. And that drove the silver price up sharply, and it drove the lease rate up to 80% for less than a day. And then the price came off. So when you say how much does it take to squeeze the market, you can jerk the market around for 5 million ounces if you're clumsy or you're adept, but you can't keep it that high simply because the stuff will come back from someplace else.
Okay, and I think the question is related to physical silver demand rather than the futures. And I guess, do you think that physical demand is ultimately what determines the price? And if so, how much physical demand rather than futures would be needed to appreciably impact the price of silver And can you potentially be somewhat quick on the answer so we can move on to the next question?
And do you really think that physical is what drives the price right now?
I think that futures drive the intraday price, and physical supply and demand drives the longer term price. And of the physical supply and demand, the most important factor is investment demand. And I'm going to say the easy solution is buy the CPM Group Silver Yearbook, because the data is right there. And you can look at when investors are buying less than 150 million ounces a year on a net total basis as an investor group, and the price is weak. And when the price gets to 150 or 200 or 220, and those are realistic numbers, this is not the strange stuff that you see from marketeers. These are the actual numbers. When you see investment demand at 150 or higher, that tends to push the silver price up on a more sustainable basis. And you saw that 2005 to 2011. And then when the demand started to fall after 2012, the price fell too. So you can see a very clear correlation between the levels of investment demand and the levels of silver prices. And that's really what you need to look at if you're thinking about silver as a long-term investment.
Okay, guys, we really do need to focus on like prices here and all this. We're seeming to get into these real high-level discussions that, unfortunately, I don't think is going to draw a whole lot of people into the sector, into the market, right? People do want to know about Basel III and all these other things. So let's keep it moving.
I will say this.
Okay.
You know, look, we like investors being involved. This is our business, right? So it's not that we're bulls and we're not going to wave our arms and put on a bow tie and say it's going to $100 because Biden's a communist. We're going to say this is a realistic way to approach investing in silver in which you can make money. You see the price go to 50, sell, or buy puts against your physical position if it's a long-term physical position. So yeah, it's high level, but this is what people really need to focus on in order to not lose money investing in silver. So, but yeah, let's go on.
Let's move on. Yeah.
Yeah, and I've kind of moved to picking questions that I got asked the most at this point, just to make sure we get them. One question I got quite a lot was, why do banks or large participants essentially dump their long positions or short during times of very low liquidity? And I was also instructed to read a quote from the Public Meeting to Examine Futures and Options Trading in the Metals Markets by Jeffrey Christian, submitted in 2010. It's on the CFTC website. And in that, the quote says, companies seeking to execute large trades wait until New York opens, finding the market more liquid and pricing more competitive. Conversely, there are times when companies enter the market with large trades during the New York pre-market, apparently with the intention of moving prices in their favor by placing a large order or orders before the liquidity is there to accommodate such trades. And yeah, that's really the relevant piece there. Are you basically agreeing with people that people are placing large trades during illiquid periods in the market to move the price in their favor, whichever direction that may be?
Oh, yeah, let me answer that succinctly. Yes, people do that. They did it much more often 2010 and earlier than we see today. I do not see that kind of activity in the gold or silver market over the last, say, decade or so that we saw in the 1990s and in the 1980s and in the early '80s. So I think, you know, the precious metals markets have changed dramatically. And one of the things that you've seen is that some of those people no longer trade the way they did, or they've left the market.
Is there an opportunity here then, Jeff? If a big buyer, if a big seller wants to come in, does that mean that it's just a more thinly traded market?
It is a more thinly traded market in the New York pre-market because London's off to lunch and New York hasn't opened up. So if you go to your bank or dealer and you say, you know, I want to do 100,000 ounces of gold or 1 million ounces of silver, they ought to say, well, let's wait till New York opens and we'll work this order. But with the advent of SLV, you don't need you don't necessarily, you can obviate having a market maker say, let's be prudent and wait till New York opens. You can go on. And that's one of the things that's very important is New York futures open at 8:30, New York stocks open at 9:30. So you have an hour there where the futures market and the options market are trading before the ETFs kick in. You know, and that's another vulnerability that in the past we've seen exploited.
Fair. We still do see that exploited here and there, though. We've seen millions of ounces get dumped in the market outside of market hours. So it's still around.
Well, if you think about it, the futures market operates, you know, depending on who you are, 10 or 15% margin. So it's a leveraged position. And the SLV tends to be 100% collateralized. So if you are looking to make a transaction, you can get more bang for your buck in the futures market, and the market price can react. And then an hour later, other people come in to the SLV or the GLD or whatever ETFs there are. So yeah, there are vulnerabilities, and that is starting in the late 90s, early 80s, when they were working on creating the first gold ETFs. We were said this is a risk that this market is facing.
Okay. Moving on. It looks like we're going to move on to the DOJ investigation that declared JP Morgan a criminal enterprise. The question is, Jeff has frequently stated that any manipulation of the gold and silver markets has been limited to a few cases by a handful of individuals. However, the DOJ case found otherwise. I'm quoting the Assistant Attorney General here. He said, for 8 years, a group of traders at JP Morgan systematically spoofed precious metals and treasury futures markets by entering hundreds of thousands of orders with the intent to cancel them before execution. The Commission's order finds that JP Morgan manipulated these markets and failed to diligently supervise its traders. The report goes on to talk about similar findings at other banks, including Credit Suisse and UBS, HSBC, and others. So is this something that's happened only a few times, or by dozens of individuals across several banks, hundreds of thousands of times, as the Assistant Attorney General stated?
Well, this is the DOJ agreement. And I suggest everybody go online and get it, because it's interesting, because, you know, pages 3 through 8, 5 pages, talk about how JP Morgan was culpable of not paying attention and supervising these people. And it was culpable of not informing the authorities when it became aware that these guys were spoofing the market. In terms of the actual spoofing, I believe there were 7 people at JP Morgan who were found guilty of being behaving. So when I say there's a handful of people at an individual bank, that's what I mean. And, you know, okay, maybe you got to be kind of deformed to have 7 fingers in your hand, but it's a handful of people, or 2 handful of people. And JP Morgan, the Justice Department said, once they found out, they came down like thunder on these guys. And in fact, the Justice Department reduced the fine from the measurable authorized fine by 15%, because JP Morgan had acted so quickly and thoroughly once they realized what was going on, and the DOJ stepped in.
Yeah, and I guess in reference to most of the spoofing occurring prior to 2010, this investigation ran from 2008 to 2016. Right. The majority of that time after 2010, and it found hundreds of thousands of instances. So is it strange to think that this is still more ongoing post 2010, like this? Well, and actually in the article I was in, it said 12 people at JP Morgan, and then had smaller amounts at other banks, so more than 7. And brought up on RICO charges, which are more serious and criminally oriented. It also says the investigation is still ongoing beyond what they've already released.
Yeah, and JP Morgan is cooperating with them. So getting to the bigger issue, spoofing, as I've said repeatedly all of my life, spoofing occurs across markets. You can even find spoofing at the green market in Union Square in New York. You know, people will come in with a big order to buy or sell things in the effort to drive that market. And it occurs across the stock market and it occurs across commodity markets. It is an issue, and it's a particularly insidious issue because spoofing, like many misfeasant and malfeasant practices, mimics legitimate transactions. So it's very hard to say, was that a legitimate transaction or was it spoofing? And we've seen numerous occasions in the commodities markets and in the financial markets and in the LIBOR and the currency markets where there's no measurable impact on the prices of the commodities, but there's evidence because these people were emailing or instant messaging, or they were talking on phones that were recorded where they say, let's do this, let's hit this market and stuff like that. So it's a difficult thing, but it's occurring across markets, and it always has occurred across markets, and it probably will always occur across markets, even when you kill the market. Because if you go back and look at the Soviet history, they got rid of markets and people were still spoofing it. So it is an issue. It's across markets, and it's not, the important thing is there has been no evidence, as I said in response to that crap on the internet yesterday, there's been no evidence brought forth that's led to a prosecution of a widespread effort to manipulate prices, to suppress them, or to drive them higher. You know, so you have.
Hasn't there been fines issued to large institutions?
JP Morgan was fine, and most of the fines I think had to do with actually the treasury market as opposed to gold and silver. But it was both markets. Yeah, but if you look at the Barclays fine, it was one person, and his own trading desk didn't even know that he was doing this. So, you know, there's no grand conspiracy. It's a bunch of people saying, I think I can make some money here. And the effects, if there are price effects, last minutes or hours at the most.
Yeah, and going off of that, you did a recent interview with Palisades Gold where you described the algorithmic trading, how it has mostly taken over all trading in the market, and it's very technically based. So does that amplify the impact of these spoofing efforts if these traders are perhaps spoofing at a key technical level, knowing that all of these algos are going to follow on to that trade and push the price around further and potentially damage these charts for months at a time if they do it right as it approaches a key level?
Well, 90% of the trades in commodities have been technically based since at least 1980. When I was, you know, just in the business for a couple of years, I was doing some research, and 90% of the trades in commodities were technically based. It's gotten more sophisticated. We didn't have desktop computers then. You didn't have people selling the same trading program based off of COMEX prices. So it does make the market more vulnerable. The other thing that makes the market, well, there are a lot of other things that make the market more vulnerable. One is the speed. One is the disappearance of market makers. I mean, if you go back to 2001, when the stock market crashed, the New York Stock Exchange still was largely trading on the floor and had market makers and specialists and other nomads that were there to buy or sell to take up the liquidity when the liquidity was shifted to one side or the other.
Okay.
And the NICE fell 46%, 43%. And the NASDAQ, which has no market makers, it's all electronic, fell 86%. So you're increasing the volatility when you take away those market makers. And the same is true, as I said, with ETFs. So there have been a lot of technical innovations across financial markets, not just gold and silver, across financial markets. There have been a lot of technical innovations in the last 20, 25 years, all of which have made the markets more vulnerable to increased volatility and increased malfeasance.
Okay, so that's where we are, right? It is possible to move these markets. It is possible to tinker or manipulate, right? At certain times, the argument you're trying to make, if we can summarize, is that it's a very short-term thing. And to your point, Jeff, I am getting some comments in here saying that there's been close to $1 billion worth of fines charged to some of these organizations. So I think some people think that you're downplaying the whole
It's far
issue.
more than $1 billion. I mean, JP Morgan alone was like 920 million, I think.
That's what it was, yeah.
Barclays was 200 or 300 million, if I recall correctly. It's way more than $1 billion.
So why say it's not widespread if it's across, several different banks, several different metals desks, and spans nearly a decade worth of time, just this one investigation? Why say it's not widespread?
When I said it's not widespread, what I meant was that you don't have a network of people across a number of institutions combining efforts to do this. And
I think one of the investigations
to suppress the price. You're finding, you will find networks. You'll find that somebody at one bank was talking to somebody at another bank. And you're talking about 4 people at 2 banks. You're not talking about these grand conspiracies of hundreds of people across dozens of institutions that are working meticulously to suppress the price on an ongoing basis. You're talking about bros, as we call them, who are saying, well, let's jerk the market around and I'll see you for a beer after work.
Look,
right.
guys, we need to start moving on from this simply because there are some people out there, right, that you're not gonna, that they're not gonna, they don't like what you're saying, Jeff. They're not gonna take that note, right? And this conversation's been going on for decades. In not
I don't
just
like what I'm saying either, but it's a market reality.
Which is
but
fine.
You gotta understand what the market reality is. There's no grand conspiracy.
Yeah. No, I know, but there's still just a ton of questions coming in, So,
I think if I had to summarize, it would be that it is happening. It happens in other markets. I'm not sure if that invalidates it happening in the precious metals market, or diminishes its impact. But I think we disagree on how big of a deal it is, essentially.
Yeah. And I think that's
we're getting a ton of questions repeatedly in the chat about Basel III, so I think we have to go there.
Absolutely. Let's
Jeff,
start out, before you get
into
your question, let's start out high level here because everyone just kind of glosses over the changes that are happening in Basel III. Jeff, can you break those down for us first and foremost?
Well, we only have 45 minutes left.
Real quick, high level.
Let me be very high level. Basel III has nothing to do with silver. So if you want, we can move on. If you want to talk about Basel III and gold, I can be very high level. The one thing to know about Basel III is that, yes, those regulations get implemented in the EU at the end of June, but Britain has left the EU and they don't get implemented until 2022. But that's meaningless because the banks have looked at the financial stringencies that will be caused in bullion banking, and they now pretty much have covered themselves already in anticipation of the increased financing costs of being involved in gold.
Okay. And a lot of the questions referred to an article that came out recently from goldmoney.com. It was titled "The End of the LBMA is Nigh." And it said, on May 4th, the London Bullion Market Association, in conjunction with the World Council, submitted a paper to Prudential Regulation Authority making the case for unallocated gold to be spared a required stable funding factor of 85% under the new Basel III regulations. So the question is, if they've already prepared for it and if it's going to have, virtually no impact, why are they requesting an exemption from this requirement, about a month before it comes into force?
It's, to clarify one of the things you said, it's going to have virtually no impact on the bullion market. It will have an impact on the bullion trading banks because it raises the cost to them of trading precious metals, of gold. So there will be an impact. And the LBMA and the WGC, and I do not speak for them, as I think I pointed out recently, we've actually probably never actually done a piece of business with the LBMA, but that's beside the point. We don't speak for them. But that paper, which I've read several times, the purpose of that paper is to try to get the rules changed because it's expensive to the banks to meet those rules. It's not going to destroy the London gold market the way some hystericals might say. It's not going to destroy the gold market. It's going to make it more expensive for the banks, but the banks have made provisions already to live with that and to live with the reduced profitability and increased costs of living with Basel III's regulations. That said, they're going to continue to lobby the BIS, the EU, and the FCA in London to be more accommodative of gold. And I should say the reason why the Basel III guidelines are more stringent is because of gold's relative lack of transparency, which the banks have been trying to combat and become more transparent since around 2008 when Basel III was first being discussed, 2005, 2008. But it's gold's lack of transparency, gold's lack of data, gold's increased price volatility, and those kinds of factors have caused the banking regulators to say we need to have more protection in the gold banking business than we do in currency business. And the LBMA and the World Gold Council are arguing that, saying, look, we've been coming up with data. We've started coming up with trade data as of, I think, 2018. And you can see that, we're moving in the right direction. We would like that rule changed. But it's not that the market's going to collapse.
Well, by putting more restrictions on banks or making it higher cost for banks, is that not going to impact anything?
It's going to impact the profitability of the banks.
Which don't banks usually pass that along? Banks don't like their profitability getting impacted.
Well, if you look at the world, there are any number of bullion banks that have either closed their bullion desks in the last 2-3 years or have scaled back tremendously. And it's not so much Basel III, it's a whole host of regulatory issues that have become much more stringent. It's the fines that a number of them have paid. It's the increased volatility and the irregularities relative to other financial markets that you see in gold. There are a number of factors that have caused banks to say, we want to pull back from bullion banking. And that has decreased the breadth and depth of liquidity in the market, which ostensibly ought to be reflected or expected to be reflected in increased price volatility. But it's not like the bullion banking business is collapsing or going away. It's becoming more concentrated the way every banking system is concentrated. I mean, if you look at the United States, there are like 3 banks now that are responsible for like 60 or 70% of mortgage originations. Banks are specializing and they're getting out of those areas and they're focusing on 1 or 2 specialties. And it's across the banking industry. Again, it's not gold and silver. It's across the banking industry that you're seeing those kinds of contractions. Gold and silver probably are suffering because they are oftentimes seen as non-core banking services by banking executives.
Jeff, this article, it continues on, and people have been asking about this. It says the LBMA's problem with Basel III becomes obvious. Unallocated gold liabilities cannot be used for funding the bank's assets, and unallocated gold assets take a valuation haircut of 15% of market value as well. In the future, the former cannot be simply offset against the latter. But bullion banks in London naturally run unallocated positions on both sides of their balance sheet. If this Basel III proposal goes through without modification, it will effectively be the end of the LBMA's forward settlement business and the end of arbitrage and hedging between LBMA members and the CME's COMEX futures contract. And the swaps in the COMEX, which are bullion bank trading desks, could be regulated out of existence. So essentially, is this requiring is this eliminating the ability for banks to offset opposing balance sheet positions in regards to gold? Do they have to hold a lot more cash to back these unallocated positions? Is that what you're describing in terms of making it more expensive? And could that cause at least a contraction in the size of, say, the fractional reserve system on top of gold and silver? Well, gold specifically for Basel III.
It raises the cost of doing business. They have to put up more collateral for gold positions. They will not, as an industry, gold bullion banking will not disappear or collapse. Most of what you've read is histrionics. Maybe the people don't know what they're talking about. Maybe they're just trying to scare investors into buying allocated gold from them. I don't know why they would say that. It's not going to cause a collapse of bullion banking. Bullion banking will continue. What we are seeing, not because of just Basel III, but for a variety of reasons, is that you are seeing a contraction in the number of banks that are offering bullion banking services. You're seeing a reduction in the liquidity in terms of the number of participants you can trade with and the depth of trades that you can do at any given time. But that is not going to spell the end of bullion banking, and it's not going to cause a contraction of the volumes of bullion banking that are done. It will further concentrate the contraction of the bullion banking business, not just because of Basel III, but because of a variety of issues, will further concentrate the trading in a handful of banks because of that. But that trading won't go away.
Okay, quick couple questions then. You can answer these real quick. You kind of answered this one already, but will this impact the overall volume of the contracts traded then in precious metals? And with a more concentrated or lower amount of people that are taking part, does that open up other countries to start to take a lead here? Some of the suggestions being China or Singapore.
Yeah. Okay. What was the first question?
Are we going to see volumes decrease on the back of Basel III?
Probably not. We probably will not see the volumes decrease on the back of this. We will see cyclicality in the volumes related to other factors like demand for metals, lack of demand for metals. The risk of regulatory arbitrage is something that we've been writing about since the late 1990s. We wrote about it in the early aughties. And it's actually funny because in my oft misquoted 2010 testimony to the CFTC, one of the issues I raised very vociferously is that they were risking regulatory arbitrage by imposing rules that don't make sense on New York futures. Yeah, the New York futures market is probably the most regulated precious metals market around. And if you increase the regulations on it, you find that people start trading elsewhere. And you have seen that. I mean, COMEX is still by far the largest market for gold and silver trading, but you do run the risk of what they call regulatory arbitrage.
Okay. So I think in summary for that, you don't think it will really have much of an impact on the price of gold and therefore silver.
Yeah, look, if I'm doing
quick clarification
where I think the gold and silver prices are going over the next 5 years or 10 years, this is not a factor in my model.
Okay.
And if you are doing research on it and it is a factor, go back to the drawing board because your model is flawed.
Okay. And sticking with the LBMA here, they recently had their annual report come out where they comment on happenings in the silver market over the past 12 to 18 months. This question starts off as, Jeff frequently states the world is effectively drowning in silver. If that is the case, why is the LBMA worried about potentially running out of silver? And they want me to read a quote from the report. It says, global ETP holdings hit a record of 1.2 billion ounces on February 2nd, 2021. As impressive as this may appear, it does not tell the whole story. As the social media frenzy gathered pace in late January, demand for coins, bars, and ETPs all jumped. For the latter, global holdings surged by 120 million ounces in just 3 days. This was concentrated in the iShares fund where the holdings rose by 110 million ounces. Given that most of the metal was allocated in London, fears emerged as to whether there was enough silver should demand continue at this pace. Total LBMA silver vault holdings versus silver allocated to ETPs in London. ETP issuers at the end of February 2021 held 765 million ounces in London against these ETPs, leaving only 360 million ounces of potentially available metal. So I guess the question is, Jeff, why do you think there is far and away enough metal to cover potential demand if the LBMA itself is saying they were worried that they might run out if demand continued at the pace it started at in early February?
Yeah. Again, I don't speak for the LBMA. I would have worded that somewhat differently. There is not really an inconsistency between what they were saying and what we're saying. The reality is there's a lot of metal. So in London, the last time I looked, you had about 725 million ounces of silver allocated to ETFs, ETPs, and you had about 450, 500 million ounces of metal that was not allocated to that. Now, some of that is coins and small bars, and some of it is allocated to other people. But there were hundreds of millions of ounces there. There are also hundreds of millions of ounces in other places, in Switzerland, throughout China, the United States. So there's a lot of silver there. And what the apparent inconsistency actually reflects is the issue of delivering silver within 24 hours to an ETP the way the ETP charter demands. And that is an issue. And then the other issue is, well, is there enough silver? And yes, there's enough silver, but it may not be there within 24 hours. And the reason the SLV changed its charter or prospectus in early February was not because they couldn't get the silver, but because they didn't know if the logistics of getting the silver were possible. And the idea of moving 116 million ounces or whatever it was that was being purchased in the SLV iShares in one day and over like I think 3 or 4 days, the idea of finding it, verifying it, in some cases moving it, can take more than 1 day. So I think the apparent inconsistency is not an inconsistency, because what the LBMA was saying was, we had this problem because there was this massive need to deliver metal into London depositories for the SLV. And what we're saying is there's plenty of metal out there, but yeah, it might take more than 24 hours to get it there.
Jeff,
is that not?
Go for it.
I was going to say, isn't it always the case that given a long enough time frame, you can find silver? But given that the market itself is based on 1,000-ounce bars, isn't there a point where all of the 1,000-ounce bars could be allocated to ETPs or individual investors, and now the futures market is waiting on smaller silver to be melted down into 1,000-ounce bars, and the retail premium situation is reversed to where commercial buyers now have a shortage of 1,000-ounce bars and are paying premiums for them because they cannot find them to deliver on futures contracts who may be requesting delivery.
Yeah, it's a theoretical possibility. I mean, if you look at it, the premiums that I was looking at today from one of the companies that we use for our clients, the premiums for 1,000-ounce bars were 2%. So there doesn't seem to be an immediate penalty for that. And if you look at some of the presentations that we've done that are on YouTube, you'll see that, yeah, the premiums at, let's call them responsible depositories and responsible dealers who sell 1,000-ounce bars, the premium shot up to 2.5%. So that's, and they shot up from, let's say, be honest, 1.5%. So there has been some tightness there, but it's not the kind of tightness that I would panic over. And I think if
Right.
somebody is telling you you should panic over it, you should say, I'm much more worried about what happened January 6th than paying 2.5% for a 1,000-ounce bar.
Okay. And
when do you start panicking, though? It sounds like this is possible, Jeff. It sounds like if there was just a massive amount of demand that came in, that it could become an issue.
Yeah. Well, there are several things. First off, people who own silver own it either for capital preservation or for capital appreciation. And again, remember that 90% of the people who aren't guns and bunker people, who aren't conspiracy theorists, who are looking at silver as a capital preservation mechanic and a capital appreciation, many of whom actually own ETFs. So let's say that something happens and there's a rush, let's say 100, 200, 300, I pick a number, 300 million ounces of people say, I want 300 million ounces of 1,000-ounce bars in an ETF, right? Well, there are, what would you say, 1.1, 1.2 billion ounces already in ETFs, much of which was purchased at $12, $15 an ounce. And those guys say, okay, you want to pay me $75 an ounce for my silver? That's great. Here's my silver, you take it. So the first place where you'll look for investors taking profits in such a squeeze are the actual ETF holders. And a lot of them are smart enough. They say, okay, the price has just gone, I bought it at $15 and the price has just gone to $50 or $60. And some schmuck says he wants to pay me $60 for it. Great, here's my stuff. Give me $60. And by the way, that's going to really give me an interesting puts, because if the price is rising, all of these guys are going to be driving for calls and the puts become really cheap. So I'm going to buy some $30 puts. I've just made $45 an ounce on my silver, and I can put that in there. And if the price comes back down to $30, or even if it comes down to $40, I've made another fortune on my puts, and I can buy the stuff back, because there are going to be any number of people who say, Jesus, I bought it at 60 and it's 40 now. So the first place you see price elasticity on the supply of 1,000-ounce bars are the ETF holders, because most of them are very intelligent people. They know what they're doing. They say, gee, if you think the price is worth 4 times what I paid for it 10 years ago, here it is. I actually have an uncle who bought a tremendous amount of silver at $1, $1.29 in the early 60s. And when the price of silver shot to $50 in January of 1980, he bought a house. And the guy said, I'll let you pay for it in silver. And we'll use the average price of January 1980, which was about $32 an ounce. The price collapsed, and by the time the house closed, the price of silver was $16. The guy honored his deal and sold the house at $32 an ounce. So the first place you see price sensitivity and price elasticity for selling 1,000-ounce bars is the ETF holders. Then you have everybody else. And I won't even guess how much silver is in the 50 or 60 silver depositories spread across China. I mean, we do have that number, but I'm not going to try to guess off the top of my head. There is an enormous amount of silver in 1,000-ounce bars waiting for you.
I guess how many 1,000-ounce bars are estimated to exist? You provide estimates on total bullion, total silver. Do you have any estimates on the 1,000-ounce bars, given that, those are probably the most transparent holdings available in the world?
I believe we're saying that there's about 3 billion ounces of silver in bar form, another 2 billion in coin form. And of that 3 billion, most of it's 1,000-ounce bars.
Okay. So related to this, in terms of how large the market is, I think there's a lot of commentary, Jeff, from you and others that this market is quite large, that there's a lot of silver out there. In the silver yearbook, it shows that in 2020, the percentage of global wealth comprised by silver is 0.015%. Earlier in the conversation, you recommended people hold possibly 2 to 3% of their portfolio in silver. So if people took your advice, wouldn't this result in 200 times the notional value in terms of demand compared to the silver market today?
Okay, well, first I said 10 to 15% in precious metals, and somebody extrapolated, well, so probably 2 or 3%. But yeah, it would, and it's not going to happen. You know, first off, you have to look at the 7 billion people who live in the world. You know, you're not going to have 7 billion people saying, let me put 2% of my wealth into silver. A lot of those people actually already have 7% or 2% or more of their wealth in silver. Because if you go throughout the Islamic world, if you go, you know, from Morocco to Malaysia and Indonesia, you'll find people who hold gold and silver in little 1 gram gold pieces and smaller and silver pieces, and they use it as money. And a large portion of their wealth already is in gold and silver. The same is true in India, which is in that geographic sphere, but it's more Hindu than Islamic. So if you say 7 billion people times 2%, it doesn't add up. You have to consider the reality. And the reality is that it's not going to happen, that you're going to have the general population have 2% or 3% of their wealth in silver. And if you look at gold as an example, I haven't done the numbers for silver, but if you look at gold, we went from like 0.2% of financial wealth to 0.8% from 2000 to 2011, and now it's back down to 2006. But if you look at that increase from 0.2% to 0.8% and you disaggregate it, you say, how much of that was due to the historically unprecedented purchases of about 380 million ounces of gold by investors over that 10-year period? And how much of it was due to the price appreciation of the gold they already held? And how much of it was due to the price appreciation of the gold they were buying over that 10-year period? And the vast majority of the increase from 2.2% to 0.8% was due to the price change of the existing gold, not the purchases. So it's very easy to say, okay, let these guys buy X ounces of silver, and that's going to take the price from $28 to $45. Well, let's make the math easy. It's going to take the price to $56, which is actually very close to our annual average price projection for the next peak. So let's say the price doubles. Okay, now you've just doubled the amount of that of wealth in silver. So you'll probably see any increase in the proportion of private wealth that's in silver. The bulk of it will be through price appreciation as opposed to acquisition of new silver.
And I think silver investors would be totally fine with price appreciation comprising the majority of that. I mean, even if it doubled, it would be 0.03% based on that estimate. Right. And earlier when we're talking about 300 million ounces at a time, you know, it doesn't have to necessarily be global. You could just take the Western world, the wealthy countries, or even just America with 300 million people. Isn't that just 1 ounce per person? What if everyone in America decided to put $30 into silver? What would happen at that point? It doesn't seem like all that much money.
Oh, you're sounding like
silver movement.
Yeah.
Or what if 1% of people bought 100 ounces? Or,
yeah, if 1% bought 1 ounce, try that. You know, Mao Zedong said, everybody turn in your silver in 1949. And sure they did, of course. He also said, if everybody in China kills 1 fly a day, we'll get rid of the flies in China. It didn't happen. So, you know, you can go to ad absurdum, anyway, well, if everybody buys 1 ounce. And you hear that with these guys who say, yeah, well, you know, if everybody buys 1 ounce of silver, the price is going to explode. And they've been saying that for 40 years. I mean, you know, they're past retirement here.
Is the difference now that there is such a strong social media landscape? You know, I doubt many people thought that we would have these short squeezes in GameStop or AMC. I realize that equities are not the same as commodities, but is it so far-fetched to think that 1 million people could join a Facebook group or a Reddit group and get into buying silver?
Well, okay, so they're going to buy an ounce of silver, so that's 1 million ounces. Are they going to buy 50 ounces of silver? you know, 50, let's say they buy 100 ounces of silver. That makes the math easy. That's 2,800. That means that the average American household is going to spend something like 14% of its annual income on a silver investment.
Well, and
so guys, here, hold
point,
on one sec. There's a great comment that came in here that
okay.
I think does kind of summarize this. Because in all fairness, look, like Jeff, I've been talking to you for over a decade, right? And I have heard this argument that what if central banks start to allocate X amount of money? And now it's filtered down to the retail investor, because Happy is right, though. There is this new ability of retail investors to band together. But this simple comment summarizes it, I think, quite well. To me, the issue seems to be that retail investors have the idea that high demand for a small piece of the total demand should have a greater influence on the price. Is that what we're talking about here? Is that it is a big market, and maybe in the short term, a lot of retail investors can come together and buy silver that can cause a price move, but
Right.
It's a big market, right? And even to your comment, Jeff, central banks are out of the play. What if central banks start allocating 1 to 2% of what they have in reserves to precious metals, right? That can cause big price moves. But to this person's point, retail investors, can they take control of this market?
And to my point, that's what we've been saying for 40 years. I mean, if you look at our silver yearbook, we said last year, investors bought about 80 million ounces on a net basis globally. And that was double the 40 million ounces that they had bought in 2019 and the 40 million ounces they had bought in 2018. And the doubling from 40 million ounces to 80 million ounces as a group, and those were mostly small investors or retail investors. There were some large institutions in there, but most of that 80 million ounces was small investors. And that drove the silver price from $15 to $28. So yes, that's exactly it. And as I was saying earlier, if they continue to buy, if they double again, they won't, but if they doubled again from 80 million ounces to 160 million ounces, then you're going to see the gold silver price over $40. I mean, that is the essence of our research over the last 40 years. Yeah.
Okay. So, you know, if retail investors come in and just buy 100 million ounces, you would expect, you know, in addition to what they've already purchased, you would expect a potentially significant price move off of that.
And we're expecting them to buy around 100 million ounces this year.
Okay. And I'm talking about in addition to whatever the market is pricing in. You know, let's say they bought 200 million ounces. How much of an impact would that change your model on price significantly?
Oh yeah. I mean, if investors went from 80 million ounces last year to 200 million ounces this year, they would have a much more dramatic impact on the price of silver this year.
Oh, and maybe
You
to
care
what
to
you're
throw out a
saying,
number?
Happy. Well, Happy, sorry. If what you're saying too is what if this demand also comes in a very short period of time, right? Rather than throughout the year.
Right. Yeah. And we're talking about demand here, and you know how, you know, theoretical questions about how much they would have to buy, but in terms of the supply side, there was a controversy recently among retail investors. I think we place more emphasis on this than any media, but the LBMA recently came out and said they revised their March inventories down by 116 million ounces. They cited a submission error by one of their vaulters. You know, if we're talking about how 100 million ounces could potentially dramatically change your price forecast, you know, why doesn't this potentially matter more than it does? And how can we trust these inventory numbers that we're basing all of these assumptions off of? You know, we're saying there's 400 million ounces available in London. They just revised it by 100 million. It seems like they just take these custodians' word for it in terms of whatever they submit. You know, should we get an independent audit going at the LBMA to verify these holdings?
Okay, God, there's a lot to unbundle there. First off, the important part. Silver inventories at rest are at rest. They don't have an effect on current supply and demand, and they don't have an effect on prices except insofar as people are aware that they're there. It is an astounding mistake, as I've said numerous times, The LBMA said that one of their vaults made an error, and that's a very big error for a single vault to make. I've been witness to a lot of sloppy depository management around the world over the years. It's an embarrassment for them. But inventory changes, if the inventory is at rest, doesn't really affect the price. So that's the one part. Second part is the LBMA does not just take the word of the vaulting depository managers. They actually do have the capacity that they can say, wait a second, this is up 200 million ounces in a month, and they can question that. So part of the failure at the end of March was the depository reported inaccurate data, and the LBMA's inspectors who look at the data didn't say, really? Could you go back and check this? And so there was a compounding of problems. Independent audits, there are independent audits of the individual depositories run by individual auditing companies, and those are, I assume, delivered to the LBMA as well as to the vaulting companies themselves. So the idea of a third party coming in with like Gestapo-like tactics and saying, we're going to count your bars, doesn't seem to me to be particularly useful. I think that what you have to do is hope that the LBMA cleans up its accounting system and is more careful going forward.
Guys, we have about 10 minutes. Let's start wrapping this up.
Yeah. Okay. In terms of potentially auditing, on the United States side of this, the COMEX, Wall Street Silver has recently been talking about raising money to fund an independent audit. Given your connections in industry, would you, potentially have the backs of these retail investors and, help potentially get that arranged if it was funded by, retail investors themselves? Do you want to, I guess it's an opportunity to potentially become a hero of these retail investors that you want to reach? Well,
let's talk about retail investors and then let's talk about Wall Street Silver, because I separate them. I'm all in favor of retail investors. The fact of the matter is that these depositories are audited, and what somebody ought to be doing is working with the COMEX, the CME, to say, let's pull together these audits into something that can be publicly disclosed in a way that is there. So it's there. So if individual retail investors want that, they can have it, and they should be talking to the CME. But the Wall Street Silver people are not retail investors, and they do not represent the retail investors market.
What would you describe them as if not retail investors?
I'm sorry, what?
If they're not retail investors, what are they?
They're commentators on the internet that are feeding into paranoia on the part of retail investors.
And I guess, can we differentiate perhaps the leaders of Wall Street Silver versus the nearly 80,000 people that are in the group?
The 80,000 people aren't demanding this, the leaders are. Let me give you an anecdote elsewhere, and I actually have told you this anecdote. Ron Paul spent his entire political career calling for a Treasury audit. And in his final days as a representative, his colleagues allowed him to have a hearing. And it's great, you can find it. It used to be on the YouTube, they may have taken it off. His opening comments in which he said, in preparing for these hearings, I discovered that the US Treasury and the Fed actually have KPMG audit our gold every year. In addition to which, I found that the Treasury has been undergoing a bar by bar audit where they're checking the bars, weighing each bar, measuring each bar. Here it is. And he said, gee, I never knew that the gold and the Treasury was audited. And he said privately to the Treasury, why didn't you tell me? And they said, well, you never asked. And what you did say about us in public was really creepy. So if a group of honest, intelligent, informed investors want to go to the CME and say, hey, let's work with the CME and its depositories to come up with a report auditing the gold and silver and CME depositories, I will help them. I actually know the people at the CME to talk to, but I will not work with people like Wall Street Silver because, oh, it's real hair. I mean, these guys are low grade. They're fucking low grade. Let's be honest.
Okay. So if we got someone else other than the spokespeople of Wall Street Silver, you would support them.
I've always said,
potentially.
I'll debate somebody, I'll work with someone, but they have to be honest, they have to be intelligent, they have to be informed, and they have to be not diluted.
Okay. I think we could find somebody there. I think people would be excited and may start raising money immediately for that.
There you go. You might be much busier than you thought.
Come along with a quarterly agent and say, here's my auditor.
There's a lot of comments I've gotten, and I'm seeing it pop up in the chat as well. You said there was 100 million ounces worth of investment demand. I believe, did you say last year or projected for this year? Sorry, just to clarify quickly.
The 80 million ounces last year. We're projecting about 100 million ounces this year. Okay.
And they're saying silver-backed ETPs grew by 330 million ounces last year, an increase of 300% relative to the prior year. And physical silver investment jumped 8% to 200 million ounces. So how does this 500 million ounce total of physical silver demand jive with kind of this 100 million number you're talking about?
Okay, first thing is the 200 million ounce number. I think I know where that came from, and it's just wrong. It's just, somebody trying to.
Where do you think it came from?
The Silver Institute.
Okay.
Yeah, and their numbers are just, listen to Keith Neumeyer. Yeah, I don't want to badmouth the Silver Institute. We created the World Silver Survey for the Silver Institute in the late 1980s. This was the first one. And we created it because they asked us as consultants, why is the silver price falling? And we said, because investors are buying less and less silver, and because the companies, the brokers and banks and dealers who market precious metals are getting out of the business. And if you want investors to buy more silver, they have to be sold the silver. So they created the World Silver Survey based off of our surveys, which are now our yearbooks, to do that, to promote silver investment demand, right? So we're all favor for that,
I think people would be happy to hear you say, listen to Keith Neumeyer. He was recently.
Keith and I sometimes get along.
Yeah, he recently bashed the Silver Institute survey on Kitco as well as Wall Street Silver in interviews, and he came to the conclusion that the numbers are all wrong, essentially, or largely wrong in that survey. But he has a much more bullish view of silver, I think. I mean, he is a mining executive, but it sounds like you guys are in somewhat agreement on this supply-demand view, and at least in terms of bashing the Silver Institute. So, what is Keith Neumeyer potentially seeing that you're not in terms of that?
Let's finish off on the Silver Institute. So yeah, Keith, the First Majestic used to sponsor our silver yearbooks, and they used to buy our research and consulting. They moved away from it, I guess, because we weren't bullish enough, or we were too expensive or whatever. But a lot of his recent criticisms have surprised me, because they're the criticisms that we've privately expressed to him and other people in the silver core silver market for years, for decades actually. So it's a issue, But let's go back to your 300 plus 200. 200 million ounces is a bogus number. Just forget it. I'm not going to deal with other people's fantasies. Okay, the 300 million ounce increase in ETFs, part of that, actually it was more than that, I thought, part of that was actually bullion banks buying ETFs. And they were doing that expressly because they were net buyers of silver 2017 into 2020, at the same time that their senior management was saying, no, we want to get out of bullion banking, not increase our amount of gold and silver on our books to record levels. And one of the ways they got rid of some of the gold and silver on their books was they bought ETFs in gold and in silver. And then they transferred those ETFs to the equity trading desk to reduce the balance sheet on their precious metals desk. And we've written about this ad nauseum over the last 12 months since this tendency, since this appeared. So the 300 million ounces or whatever it was, that increase in ETFs last year was not all investors. Second thing is what you have seen since the ETFs were created was people selling 1,000-ounce bars for ETF shares, because it's a lot easier for an investor to have ETF shares than it is for him to have a 1,000-ounce bar. We have a fund manager who buys our research.
Jeff, we're kind of running out of time.
Yeah.
I wanted to get this last one in.
Okay, one more quick question here, Happy, because yeah, we're kind of all over the map here.
Yeah, we got maybe 20% of the questions in, so I had to jump around to the ones that I got requested the most. One more that it may actually endear you to Wall Street silver types, given I think I've heard your opinion on it. The Perth Mint unallocated accounts have recently come under some scrutiny and scandal, as some would call it, for potentially not holding all of the silver and gold that they claim to have in these programs. Several people have called them out for this. The CEO has done a series of interviews to try to calm it down. But is this actually something that should be controversial? I think the nature of these programs is that they are balance sheet items. They don't necessarily claim to have all of this metal on hand. And is the real issue the fact that Perth Mint and other programs like this have simply had kind of deceptive marketing to suck in retail investors with high fees? And essentially, the big headline on all of them is no storage fees, implying that you're getting physically stored metal for no storage fees. Is the issue deceptive marketing, and everybody should just know that this metal is not all there to begin with? In terms of actually, yeah, go ahead.
I haven't looked at their marketing, so I wouldn't say that it's deceptive or not. So I can't really say if they were deceiving people. I can say that it's very important for investors to know what they're investing in. And you see that oftentimes investors don't know that. And that's not just limited to precious metals, it's across financial markets. So, I think that's it. As you know from our discussions, my issue with the Perth Mint certificate, I have no problem with the Perth Mint per se. And we have clients who store metal there. We have clients who refine metal there, and they're very happy with those services. The Perth Mint certificates, I think, have some problematic issues in that they're very expensive. If you say to them, I want to convert my Perth Mint certificate into metal held someplace else, it's very expensive and cumbersome, like an ETF. And again, I think it's caveat emptor. The investors should have known that. We always tell investors, if you want to buy silver, buy silver. And
if all of the holders wanted to convert tomorrow, provided they had the manpower to do it, would there be enough metal there, perhaps on site to do this, or is it just backed by a general balance sheet, assets, not necessarily metal entirely?
I have no idea, because I haven't looked at it, because it's not an issue that I think is germane to the key silver market. So I haven't looked at it. I don't know how much metal they have. I don't know what the controversy is. I don't know what their outstanding is. But if the more worried people say, well, let's just close this out and let's liquidate this, and there's not enough silver there, the Perth Mint can get the silver, even if it doesn't have it. So it's one of those things that could cause a disruption for days or weeks, but then it probably gets resolved.
And that's a whole other discussion. There's a lot of stuff that we can talk about here, a lot of questions that have come in, but we're already at the 2-hour mark, guys. So maybe we'll do this again, right? Because there are so many questions. But quite frankly, hey, thank you both for taking time. happy. Any final comments that you want to leave all the listeners and attendees with?
Yeah, sure. I mean, I wish I could get to, you know, a lot more of the questions here. I actually would estimate we probably only got maybe 20% or so. I tried to prioritize by the number of repeated questions I got on all of these. But Jeff, if you were willing, I'm sure people would want to hear your answers to the rest of those at some point. Perhaps there could be follow-ups to this, but I thank everybody for tuning in and supporting this, and for submitting all of these great questions.
Okay,
Jeff,
well,
wrap
first
us up. Thank you, CPM Group.
I want to first thank you two guys for doing this. It's very good. As you know, Cory, and other people know, you know, we used to do these coffee plots. It was a dessert at the Silver Summits, and these things would go 2 hours, 4 hours. Yeah, at one point the hotel asked us to stop because the mass transit was stopping it, ending it, you know, and the people, their staff had to go home. So we're amenable to it. Let's see what the reactions are to this. You know, again, our view is we try to be right, not bullish nor bearish, and we try to be honest and accurate and unbiased. I have made a very nice career in commodities research, especially precious metals, and I don't like it when I see people coming in and despoiling parts of it. And I don't like it when, as Rudyard Kipling say, I see knaves twisting the truths I've spoken to make a trap for fools. And our purpose is to help investors make wise decisions and make profits from their investments. And if we can do that with another one of these, we're all gung ho.
Okay. Hey, there we have it, guys. Thank you everyone for tuning in. We're really just trying to get information across, right? And I know not everyone agrees with it. Not everyone will agree with it. There's a lot of different opinions out there, but quite frankly, I think we're all trying to take it from an investor standpoint of how we can make money. Some short term, some longer term. Different strokes for different folks, right, Jeff? Thank you again, Jeff, for inviting us, and thanks for hosting it.
Thank you all, and thank you to the listeners and attendees. And yeah, we'll be in touch probably.